Hi, and welcome to the January Multifamily News Wrap-Up from Sales Inc., Accelerated Apartment Leasing Solutions. Sales Inc. delivers measurable return on investment with their pay-per-lease model and proven leasing agent techniques. And now on to the January Multifamily News Wrap-Up.
Home builders are hedging their bets on multifamily properties. Lennar Corp., the largest U.S. home builder, gave the go-ahead on a $1 billion plan to capitalize on rising demand for apartment rentals. Over the next 3 years, the Lennar Multifamily Investors subsidiary will construct 6,500 apartments beginning this year, with a 316-unit community in Jacksonville, Florida, and a 264-unit community in Northeast Atlanta, Georgia. Construction for these two communities is already underway, said Lennar CEO Stuart Miller. Other rental communities in the pipeline may be located in Chicago, Charlotte, Dallas, Miami, San Francisco, Santa Barbara, and Seattle, where the company has open offices. Should the billion-dollar deal succeed, Lennar would be the first major builder of single-family homes to move into multifamily housing development to drive profit. But Lennar isn't without competition. Other builders entering the multifamily market include Toll Brothers, Inc., which has invested over $15 million in a 398-unit project in Pennsylvania to tap into the lucrative student housing sector. Meanwhile, Beazer Homes USA, an Atlanta-based single-family builder, seeks opportunity in rising demand for rental homes in the Phoenix and Las Vegas markets. Constant surprise, often in the form of resident turnover, is the bane of many a property manager. A 2011 survey from Satisfax reveals, however, that seasonal vacancy is easily preventable. Here are the top 3 factors impacting resident retention in multifamily properties. 1. Maintenance services. Residents complain the most about work orders that are insufficient or never completed in the first place. One way to combat this perennial problem is to follow up with residents to get feedback on whether the issue was resolved. 2. Safety and security. Dissatisfaction with safety and security within an apartment community is the number 2 reason why residents move out. And 3. Office staff customer service. Residents who define ability to communicate with office staff as difficult are more likely to turn in their keys at the end of the lease. One way a property manager can prevent turnover is to open communication across multiple channels, including cell phones, texting, email, and social networking. In good news for the U.S. apartment industry, the National Multi-Housing Council, or NMHC, and the National Apartment Association announced a renewed partnership under the joint legislative program for 5 more years, representing the industry on federal, state, and local levels. Established 2 decades ago, the program unifies the voice of the rental housing industry in legislative areas, said NAA President Douglas Culkin. The NAA, working through 170 local affiliates for its 60,000 members, will collaborate with the NMHC's legislative and regulatory staffs on Capitol Hill. The continued partnership will push for balanced housing policy to meet growing demand of America's 17 million apartment renters. Apartment research group Axiometric forecasts a rental growth of 3.6% in 2013, owing to continued job growth, rent increases, and absorption of new supply. Due to this continued growth, the NAA-NMHC partnership will stress the role of the apartment industry in debates over critical policy issues like the economic recovery, said NMHC Chairman Thomas Bazzuto. Landlords depend more and more on mandatory renters insurance policies to protect property losses due to fire and other damage, according to the survey results from the National Multi-Housing Council. Currently, 84% of multi-housing companies require residents to purchase renters insurance, a sharp 22% increase from 2011. To gain more control, property managers have been partnering with insurance providers, often bundling monthly premiums with rent and collecting administrative fees from insurance companies. In other cases, firms provide the apartment coverage policy directly to renters, so long as it's not prohibited by local law. For property managers who must skirt directly, requiring tenants to buy renter's insurance, providing a list of preferred providers is acceptable. Experts advise clear communication when it comes to mandatory renter's insurance, specifically suggesting that managers explain why coverage is mandatory and how it helps renters by preventing financial burdens as much as $50,000. Experts eagerly forecast another bonanza year in the multifamily borrowing industry. Several trends indicate free-flowing capital in the permanent and bridge loan spaces, as well as in construction finance. Here are the top trends for 2013 capital markets. Apartment buyers have been moving away from highly competitive first-tier markets, mainly because secondary markets outside the major metro areas have more growth potential in rents and values, experts suggest. In the long-term multifamily mortgage sector, more local, regional, and national banks are offering deals on 5-year and 10-year fixed-rate loans. The pipeline of FHA D4 programs remains robust, and a compelling option even as banks offer more attractive options. Banks continue to lead the pack in bridge loans, with floating rates mostly around the mid-200 BP over LIBOR. But non-bank financial institutions are also getting into the bridge lending sector, offering floating rates predominantly in the 250 BP to 300 BP range of LIBOR. Brought to you by Sales Inc. With accelerated apartment leasing solutions, Sales Inc. delivers measurable return on investment with their pay-per-lease model and proven leasing agent techniques.